Hello and welcome to the latest Insider interview. Our guest today is Hugh Sergeant, manager of the River and Mercantile UK Recovery Fund. Hugh, thank you very much for coming in.
Morning, Sam. Good to see you, and thank you for inviting me.
We've seen a recovery in UK shares. You look for cheap companies. Are there still lots of valuation opportunities in the UK market?
I mean, there are, Sam. I mean, from a risk-adjusted perspective, I'm still really banging the table because I think there's less downside than a couple of years ago in terms of I think the economic background, the recovery phase of the cycle, the change of government is clearly supportive of the economic background. So there's less element of uncertainty. Meanwhile, valuations are still, really attractive. So if you look at the overall UK market, it's trading on 10 to 11 times earnings, which in absolute terms remains attractive. If you look at it from a relative perspective versus, say, the global benchmark, quite a few of the longer-term value indicators, like price to book or price to sales, the UK trades 50% cheap versus that global benchmark. And then if you drill down into individual companies, you can still find lots on single-digit earnings multiples. Some of them maybe are, our classic recovery shares where you need to look through the next couple of years to the profitability they can make in a couple of years' time. If you do that, then they might be trading on 4 or 5 times earnings multiples. So the valuations remain very supportive, and as I mentioned, the economic fundamentals are improving. So that combination from a risk-adjusted perspective means that I remain high conviction about the opportunities in the UK market.
And where are you finding exciting opportunities today? Are there more opportunities in the larger company space or perhaps the smaller or micro-cap space as well?
Yeah, I mean, I think the latter. I think the small and mid-cap space is particularly exciting at the moment for a couple of reasons. I mean, the first is that traditionally they get derated during the period of economic uncertainty, and that's what's happened over the last couple of years. They actually came out of the COVID crisis on quite a bull market, and then as interest rates started going up and economic uncertainty re-emerged, they went into quite a severe derating, and that was combined with what I describe as a buyer's strike. So because there hasn't been much capital generally applied to UK equities, at the more liquid end, that's had an exaggerated impact. So few buyers, quite a few forced sellers, illiquidity, creating significant opportunities in small and mid caps. So our preferred areas are that small and mid cap area. It's the traditional value part of the market, which clearly includes large cap. Examples of what you mentioned would be things like Lloyd's, Prudential, which is derated because of its exposure to China, and then the classic kind of companies that benefit from an improving economic background. So it's consumer cyclicals, house builders, real estate, the advertising sector. So that's classically cyclical and includes a large number of high conviction recovery stocks. I would, I suppose, point to some of the traditional broadcasters that are actually very valuable for the English language content they produce. So an ITV or a smaller player, STV, would be areas to highlight.
We now have a new government. Labour is in charge. What opportunities does this present for you as an investor?
I think it's, in general, I think it's bullish. Two reasons for that. I mean, the first is we've had a period of uncertainty the last 6 or 7 years. I suppose post Brexit, that itself created uncertainty, and then the rotation that we saw in terms of leadership of the Conservative Party and therefore the government created uncertainty. And now the new government clearly have a significant majority, and they've got a cabinet that have been doing their jobs shadowing for many of them for many years. So I think that just allows a much higher degree of certainty, and that will allow other investors that have kind of discounted the UK market because of the perceived turmoil to re-engage with our market. The second aspect would be the policies of the government, which are clearly going to be tested over the next couple of years in terms of actual implementation. But the general direction is one of focusing on growth, which I think is the right aspect, because you can only pay for things like the NHS by delivering more substantial economic growth, and they realise that. So they're looking at all the tools available to them to try and generate more growth, and I think that's the right aspect, and also will allow investors to re-engage. And then they're probably coming into power at a time when the economy was naturally picking up anyway. We've seen GDP estimates revised upwards, interest rates will be cut, so I think there should be a little bit of a following wind. So all that as a kind of combination, I think will allow this government to be associated with, I think, attractive returns for UK equities and a more supportive economic background.
And what sectors do you think will benefit the most from this new government?
Yeah, I mean, obviously there's some areas that they're particularly focused on, which should be beneficiaries. I mean, and are also, I suppose, participants in our overall view that we're going to go in a period of greater economic strength, in particular on the domestic side of things. So I suppose classically everyone's talking about the builders, and we would agree with that, house builders. So, and an MJ Gleeson, which I've mentioned already, it would be a classic kind of beneficiary of the building cycle, in improving, volumes increasing, because volumes are depressed in that industry at the moment. And another good example actually would be Henry Boot, which is more focused on the planning side of things, so working land through from landowners and getting planning permission for housing or other forms of construction. And clearly the Labour government are focused on reducing the log jams on the planning side and allowing volumes to pick up, so that should be specifically supportive of the likes of Henry Boot. And then there'll be a more general beneficiaries, I think, of just an improving economic background and also greater confidence. So the greater confidence aspect, I think in particular, will be supportive of small and mids. And I didn't really drill down into the micro cap side of things when you asked the question, but I do think that is also a particularly interesting part of the market. Tends to get very depressed when the cycle's against it because they're so liquid, but many of them could be beneficiaries of an economic pickup. So we have increased our allocation to micro cap. It's now running at, these are stocks that are below 100 million, running at 6% of the portfolio, and it could be the world of, a bit like Somero, which came out of the global financial crisis and went up multiple times. We think there'll be one or two stocks in the microcap world that will be able to generate those very powerful returns.
You're underweight some very highly regarded UK companies, RELX, AstraZeneca and Unilever. So why is this?
Well, we've always been structurally underweight that part of the market, normally significantly underweight, so you would kind of classify them as quality compounders typically. But we have allowed ourselves to, I suppose, somewhat opportunistically apply capital to those types of stocks when they're temporarily out of favour. So RELX was an example that got quite derated during COVID because some of its businesses were exposed to industries that suffered during that period. So it became quite cheap and we applied capital to that. Actually, it's now been quite significantly re-rated, so we've quite recently exited that position. AstraZeneca, likewise, about a year ago, did derate and we put some capital to work in that. Unilever is amongst a number of consumer staples that have actually struggled over the last couple of years. In an inflationary period, they've found it difficult to pass on all the cost increases that consumers that typically have been quite price resistant to staples have been more wary, and therefore their business fundamentals have deteriorated over the last couple of years, and that's meant they have been derated. Actually, the poor performance of consumer staples, which we have been underweight in, has contributed to our relatively strong relative performance. But we do see opportunities there. Unilever would be a good example, and there they also have the catalyst of management change, and that management focused on let's look at where our really strong core operations are, core brands are, and divest of some of the weaker areas, and we think that will allow returns to improve. So it's almost a recovery stock, so hence having a reasonable amount of capital in Unilever today.
And I know you prefer value and recovery shares, but are there any typically expensive shares that you own in the portfolio?
Yeah, I mean, that's a great question, and it is an area of excitement for me, actually. So as you say, the portfolio has always been focused on value and recovery stocks, but we're a broader church than just buying cheap stocks, and when there are structural growers that are temporarily out of favour, it is a potential hunting ground for us, and that's definitely the case at the moment in the small and mid-cap part of the market. Either it's companies that have missed short-term growth expectations and been derated as a result of that, or companies that have suffered during the buyer's strike in the small and mid-cap end of the market. So they might have been very popular a few years ago. Small cap funds attracted a lot of capital, pushed up valuations. A lot of that capital has come out, and that's ended up with depressed valuations. So in terms of the portfolio's exposure to that part of the market, it's probably definitely at the high end versus the last 15 years. So structural growers on really quite attractive valuations as we speak. I mean, examples of that would be Wise in the fintech area, Global Data speaks for itself, a leader in terms of data manipulation. Treat, which is a smaller play on flavours and fragrances and has a particular niche in more sustainable production of flavours and fragrances. Molten Ventures, which focuses on PE and venture capital into growth type stocks. So those would be 4 examples of companies that have quite aggressively derated over the last few years, have attractive medium-term structural growth characteristics, and an exciting part of the portfolio today.
And finally, the question we ask all of our guests: do you personally invest in your portfolio?
Yeah, I mean, good question. I think it's essential for fund managers to have substantial skin in the game. So I do. I have seven-figure sum invested in the UK recovery strategy. Have continued to apply capital. It's there to create wealth for investors. We think we've been able to deliver that over the years. We're very confident about being able to deliver that over the next 5 to 10 years. So yes.
Hugh, thank you very much for coming in.
Thank you very much for your time and all your insightful questions.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.